Hi guys, I drive past these apartments almost every single day, and every time I go past the apartments I ask myself the same question, and that question is, how did they actually make money? They've been selling apartments for the last 10 years and they still haven't sold yet. Well, on the large scale stuff like these big towers behind me, I understand they get their money really cheap. They're often a builder as well, so they collect their building margin. They also vertically integrate all their services, so they don't pay for their sales because it's part of what they offer. And they are commonly syndicators, meaning if they lost money, it's not their money in the first place. But behind this was the city of Belmont, and there was a whole range of mum and dad developers or small scale developers that lost money through 2011 till now. And what I wanted to cover off on this video is a bit of what developers hate talking about, and that is losing money. No one likes to talk about losing money or projects that didn't succeed. So what I wanted to talk to you today about is the 8 mistakes that I have seen commonly from small time or large scale property developers that result in them losing money on a project. Then I will give some examples of this so you can understand when it takes place. And finally, I'll talk about from my own battle scars how I do things differently so that I don't end up making the same mistakes. So let's get over the bridge, let's get into Belmont, and let's start talking about it. The first mistake in property development is if you are an expert in one area, this doesn't necessarily carry through to all of property development. For example, if you're an architect and you understand the planning and design side really well, this doesn't necessarily mean you understand the construction efficiency or resale stage of property development. And likewise, if you're a builder and understand construction efficiency, it doesn't necessarily mean you understand the market research and sales or possibly planning and design. For example, let's just say that you understand construction costs really well, and with that knowledge you're able to save 10% of the construction costs on the project when you compare it to my feasibility. Now that 10% saving on construction cost is massive, and it's likely to be smaller, but for this example let's just use 10%. When you put that 10% into a sensitivity analysis, that really only translates to a 6% increase in your margin on development costs. Now that is a good and healthy increase in margin, but it shouldn't be a deal maker or deal breaker. And the other thing to remember is that I allow a 2.5% construction contingency. So once we take that into account, the differences really on margin is only about 4.5%. Also, if you're an architect or designer and you remove the design as well as documentation costs, this might only translate to a saving of 1 to 2% increase in the margin on development costs. Ultimately, these are both good improvements, but they shouldn't be deal makers or deal breakers on a project. How do I do it differently? Well, firstly, I apply the 80-20 principle. Now, what that means is that you get 80% of your results from 20% of your effort. And with that time saved, you split that 20% up across all the different stages of the development process, whether it be site selection, product market fit, planning and design, you could be construction tendering or engineering, and finally the marketing and sales. And this way, you get 80% of results across all the different facets of property development. Remembering as a property developer, the 3 areas you add value is firstly the consolidation of capital, or getting the money together to fund the project, followed by the team formation or selection, making sure you get the right people, followed by the accountability in terms of the price of those people, and also the delivery and making sure they deliver on what they promised. The next mistake is developing for you and not the buyers. The buyers aren't you, the buyers are buyers. This can commonly happen when you're sitting down with the builder, the designer or architect, and as the developer you get the final say on finishes, selections and plans. So they come to you and say you can have X or Y, or for a little bit more you can get Z. Now the worrying words to watch out for is when you select Z by simply justifying to yourself that you're going to get more on the resale anyway. Ultimately, that is an emotional decision or lazy. It is not backed by data or examples where you can prove that by selecting Z, you have achieved a higher sale price. On the flip side, the other is being solely focused on dollar cost. Ultimately, when you invest money, it's not about saving the most money, it's about getting the biggest return for the money that you have invested. A way that I've learned to do it differently is, say for example, the builder comes to me and say, for a little bit more, do you want full height tiles? I jump on realestate.com, I look at comparable projects and I see, do they have full height tiles in their pictures? Or if the builder or designer is saying you can get a 110 square meter unit on here, or you can get a 120 or 130 square meter unit on here, I go back to actual sales and I work out on a rate per square meter does that extra unit achieve a higher rate per square metre, and will it improve my feasibility? Another good tool to use is RP Data's withdrawn listings. This is commonly used for buy-selling agents, but as a developer, what you can see is properties that have come to market that haven't sold, and at what price they were on the market, and then they've been withdrawn, and what types of finishes they had, and making sure that you don't make the same mistakes as that developer. The next mistake is being a bull market developer, and that is scaling without failing. If your property market has been going up 5 to 10% every year for the last couple of years, and you've been doing projects and making money and banking more money, and your projects have been going up, you need to take a step back and check if your numbers reflect actual profitable deals, or the increase in the property's values are what driving your projects to profitability. For example, let's just say you've been in a property market that's seen year-on-year growth of 5 to 10%. Now, I'm not going to pick any names. Let's just say Sydney, that I'm not picking its name, has had 5 to 10% growth. Now, even on small projects of 12 months, that 5% growth translates to a 5 to 6% increase on the margin on development costs. If it's a 24-month project, that might be a 10 to 12% increase in the margin on development costs, and pretty much anything that is double story is taking just shy of 12 to 24 months. How do I do things differently? Well, first things first is I never blue sky a feasibility. Well, what is blue skying a feasibility? Basically, that is allowing an escalation rate on the end values of your product at the end of the development. For example, allowing a 2 to 3% increase on the market value every year for 3 years while you're doing the development to sell them for almost 6% higher at the end of the project. That is not sensible, because if the market turns, and ultimately it will, it can lead to not so profitable developments. The next thing you need to do is deconstruct the numbers at the end of every project and be honest with yourself in two areas. Firstly, in terms of construction costs, you're looking for variance between your initial feasibility and your delivered feasibility, and you want to work out what the root cause of those variances were, and then put those into your due diligence checklist to make sure it doesn't happen again. The other thing is in terms of end sale values. Now, if the market's gone up 5 to 10%, but you're selling your dwellings for the same as what your initial feasibility said, is the fact that the market improved hiding a bad project? And that's a question you have to ask yourself. The fourth mistake is don't be a price setter unless you are immensely experienced in development. And if you're immensely experienced in development, it's actually not price setting, it's picking a niche and having perfect product market fit with that niche in order to be able to achieve a better sale price. An example of this is when you're working out end sale values for your stock, and the price that you need to achieve on that in order to make the development profitable is close to or above any other completed stock which has been sold. How I do things differently? Well, first things first is I jump on RP Data and I download 2 years of sales history of the locality or suburb in which I'm conducting the development. I then clean up the data, taking into account momentum on price and the type of product which I'm delivering. Once the data's clean, I then create a histogram based on the volume of sales in each particular price point. And as a rule of thumb, I make sure that 80% of properties which are sold have achieved a lower sale price than me, and only 20% are trying to achieve a higher sale price than me, or something close to that. For land, I like to do things a bit differently. I create a scatter plot where I compare the rate per square metre that land is achieving in contrast to the size of the land itself, as people often don't understand that you get diminishing returns based on the size of the land that's being sold. The fifth mistake that property developers make is saying yes too soon. In a hot market, good deals are hard to find, and if you're an inexperienced property developer, often it's easy to find a good deal. We often overstate our own ability even though we don't have any experience, so be cautious of this fallacy and make sure that you don't say yes too soon to a property deal. For example, when I'm looking at other people's deals to invest in, or I'm doing numbers on my own projects, for developments that have margin on development over 20%, I scrutinise those numbers more than deals at 15%, whereas as an amateur developer, you often go for the deals that have higher returns. Now, in my experience, it's more likely there's a mistake in my assumptions that have got the deal to over 20% than the actual deal achieving over 20%. And this is quite obviously how I do things differently. When the margin on development is higher, I scrutinise the deals a lot harder. The sixth mistake that developers make is FOMO, or fear of missing out. And it's a common misconception that development is only successful based on timing. Timing is a demand side characteristic, where FOMO, or fear of missing out, is supply side. And I'm going to get into that. This brings me on to my example as to why I was standing in front of those apartments at the start of this video. In 2011, the City of Belmont increased the zoning of their suburbs, and at the same time, the state government relaxed zoning around apartments, which resulted in a hell of a lot of apartment development in the City of Belmont. Now, a lot of amateur developers got in there and looked at all this development and thought, geez, all the other people are doing development. This must be where the market is to make money out of property. When you go back and look at the data, the mistake is quite obvious. In the years prior to 2011, the average amount of one-bedroom apartment sales in the City of Belmont was around 10 to 20 apartments. In the 2 years after the rezoning, 200 and 200 apartments were sold, which is 10 times the previous year's demand. This ultimately led to price reductions and lots of developers losing money. How should you deal with rezoning markets differently? Well, first way to do this is through hot potato. First in, first out, get your ducks in a row and do it with experience. The next way is a low land base. If you bought in prior to the rezoning at a cheap price on the land, ultimately this means you can resell the end product cheaper. The third option is a plan B, where the exit strategy is to hold it, provided you know it's going to be a long-term plan where in the short term you may have negative equity. And the final way is to just simply avoid the rezoning areas or where there is fear of missing out. The seventh mistake I had on my list is shortcutting due diligence. Well, that's just stupid. I'm not going to go into that. You need to do thorough due diligence. The eighth mistake developers make is massaging their end sale price when the development doesn't stack up. The best way to do feasibilities is get your end sale price first, deduct all your costs, and this works what your residual land value should be. The way to fix this problem is to subscribe to this channel. Go down there and subscribe, because I guarantee you'll be able to sell your development for whatever you like, millions and millions of dollars, whatever you like. Just subscribe. No, it's not guaranteed. I'm not guaranteeing it, but subscribe anyway. An example of how this happens to developers is they like the deal or invested in the site or like the location or familiar with the area, and they do their numbers and they think, well, if I got X, Y, Z, the numbers still stack up, so I probably should do the deal. That's wrong. You shouldn't do that deal. As I said before, work out your end sale value, deduct your costs, and get your residual land value. And as you progress through due diligence, it's also smart to take into account a range of different ways to work out your end sale price. Comparable sales is the most obvious and preferred, but also looking at stock on market and applying a discount, looking at residual land value plus the construction costs, taking into account other projects that are very similar in different markets, and then discounting back based on the median price of the area. And finally, looking at other projects and discounting back bedrooms or bathrooms or finishes to work out your end sale price. Using all these different strategies, what you want to make sure is that there's not a huge divergence between where you think your end sale price will be, and if there is, you need to investigate it more. The next mistake is overextending yourself in terms of financial capacity or time commitment, as well as not having a plan B. For example, when you break down development, there are often bottlenecks in the process. For example, site selection is a bottleneck, financing is a bottleneck, construction is a bottleneck, and sales is a bottleneck. If you only have one path through each of these respective bottlenecks, you have a problem. I hate to quote academic research on a YouTube channel, but it summed up property development best. Basically, they simulated high variance investments, which property development is, with leverage, and they had a positive payoff, so each time it's more than likely you will still make money. And what they found was, due to the high variance or the likelihood that you can blow up your portfolio, in the long term, it's likely that the investors would lose money, and that is what property development is. If you don't de-risk it, you are probably going to lose your shirt. And this brings me on to how I do things differently. Property development is not about risk taking, it is about risk management. For example, in the due diligence planning and design phase, you want a cut and run feaso to mitigate the planning risk. In the financing stage, you want to make sure you have plenty of lending options. In the pre-sale stage, you want to take into account the possibility of a capital raising so you don't have to get pre-sales. And in terms of the exit strategy, you want to model out what it looks like to hold the development. And this way you have a lot of plan Bs, and if things don't go your way in one of those areas, you are still able to keep your shirt. And the final mistake that property developers make is not subscribing to this channel. So go down there, Click subscribe, go down. Click subscribe, do it. So you know now 8 ways that property developers make mistakes, examples of when that could be happening in your project, and how I do things differently based on my experience to make sure that I don't fall for those same mistakes. Until you de-risk your project or I make my next video, best of luck and goodbye.